So Ray is just like, look backwards, last 500 years of history. Every time you've gotten to this point where you're gliding, it always ends with either economic war or actual hot weaponry war. And you need this level of trauma so that people will finally go, fine, everything that I owed, I'm just going to let go of it. Whatever, it is what it is. I just want peace. And so you get this complete upending of everything. We reset, we go back to zero, but we do it in the most grueling, brutal, sacrificial way possible. I mean, and I hear this a lot from people like, this all rebalanced in 100 years. Sure, but that is cold comfort to millennials who could never buy a house, right? Like,
so yes, but this is where the fourth turning comes to me, right? I think we are at economic warfare. Everybody needs an enemy. So we've decided that China, Russia, whoever we want to be our enemy is our enemy. So we are economic warfare for the share of the pie. But the world is not, it's not actually a fixed pie. There's an abundance. And that abundance is the other economic warfare, which is technology. Right? That's happening at a massive scale. And it's going into space, it's going everywhere. So we've got physical kind of warfare, economic warfare over technology, which is what Taiwan is all about. You know, they own the secret code, which is the ability to produce computer chips in ways that nobody else can replicate. So there's that. And then we are at war with each other as the population is split and wants to blame each other for what has happened, when in fact it was actually the baby boomers that actually caused the problem in the first place. The people caused the problem to the people.
In fairness, it was the greatest generation that had all the sex that gave birth to the baby boomers that created the problem. And this is where it gets tricky, because God bless the greatest generation for fighting the wars, et cetera, et cetera. Okay, before we keep going down that road, because I want to keep this all in the construct of your everything code, because this was very enlightening. Okay, so you just walked us through that first part about why we're going to keep having these financial crises, and the only way out of that is to print money, basically. Okay, next section. And the only way, here we go. And the only way of solving this is putting it on the central bank balance sheet, because there's not enough GDP to pay the interest. This is what you were just talking about. So if you think about GDP growth, let's call it 2%, and let's assume that interest rates are 2%, which is roughly where they've been since 2008. So if the government is 100% GDP in debt and GDP grows at 2%, but interest payments are also at 2%, that's all of GDP growth just to pay the interest on the US government debt. But the private sector, excluding the financial sector, so households and corporations, are another 120% of GDP in debt. Well, that will give you negative growth every year of 2%, and it just compounds. So what happens is those interest payments go to the Fed balance sheet and they monetize it. Again, this is what we were just talking about. So then the private sector is not competing with the government, and that was provable across all major economies. It's like they all decided that they're too far in debt, and the only way to solve this is quantitative easing. And then I started thinking, well, if I know this to be true, and I know that the central bank balance sheets are 97% correlated with the asset prices, well, all I need to do is use forward-looking indicators to predict the central bank balance sheets and/or interest payments. Talk to me about this 97% correlated with assets. That seems like having a crystal ball.
So it doesn't. It actually reflects today. So you could basically, as I explained before, the thing that's actually driving the S&P 500 is the Fed balance sheet. It's not companies getting more valuable. When you say
driving, you mean driving the price.
Correct. So it's an optical illusion. It's a money illusion.
So the price simply rises to meet the level of inflation caused by printing money.
Correct. You're readjusting the price. So that is what's going on. And so then when you understand that, and it's 97%, you understand that nothing matters apart from this liquidity, which is what I've been trying to tell people, is sorry, all your economic models are wrong. Yes, you need to forecast the business cycle to know where you are in the probability of printing money cycle, but that's all that matters, and it drives assets. And that's why people right now are getting very angry because the stock market's going up, and they're like, yeah, but don't you know there's a recession? Yeah, I know that the answer to a recession is more cowbell, printing of more money. Which is why I explain to people.
This is what I'm talking about with, as people become aware of these issues, as you zoom out and you see the gigantic crater, you begin to realize, oh, we're in a recession. that means they're going to print money. So in a recession, prices are going up and people are like, yeah, I know where this goes. So that's crazy. And that it'll be very interesting to see what the knock-on effects are of the everybody becoming aware of these patterns. And I've heard you say it's almost always the path of most pain is the path that ends up actually happening. And so as we begin to predict, oh, this is what's going to happen, the fact that we can predict will have some very sort of painful consequences.
The important point being here is I know what drives liquidity. It's driven by the business cycle. And there are certain cycles that are forward-looking. The Chinese credit cycle happens to lead by about 18 months or 2 years.
For people that don't know what the business cycle is, can you give a quick primer?
The business cycle is the ebb and flow in economic activity that occurs, and that's a boom and bust, a recession expansion.
Is it caused by interest rates?
We don't really know what causes the business cycle. It's caused partly by interest rates. It's caused by excess production, excess inventories, too limited inventories. There's many things that can drive a business cycle, but it's observable and has been observable for millennia. And one of the things we do is when the business cycle is too hot and inflation starts rising, central banks tend to raise interest rates. That tends to bring down economic activity. I think even without a central bank, interest rates would rise naturally, because I think the free market can set interest rates without a central bank. And then the economy slows down again, and we see this endless cycle. So what I think my hypothesis is that, okay, this is very observable. I think it's going to last, this relationship between assets and the central bank balance sheet because of the mechanism of debasement of currency. And I can forecast out what the business cycle looks like. And I also know the amount of interest payments that need to be made because they happened 3.5 years ago. And I can see how far the balance sheet's going to expand. So the balance sheet right now is $6.5 trillion. And it looks like it will get $7 trillion or so. And it looks like it will get to $12 to $14 trillion by the end of 2025. So that puts, and there's a number of other ways I've proven this out in this whole thing. And I'll send you the whole piece myself. I've not really gone public with all of the whole thing of how it works. But in the end, that puts asset prices massively higher than here, hugely higher. So we're looking at more than a doubling of the NASDAQ from here. We're looking at another gigantic crypto run. That's into 2025. So we're seeing huge moves that just come from the debasement. And I've gone through in the Everything Code article that I wrote for Global Macro Investor, which is my kind of premium research service. In that, I've gone through various ways of proving this all out. So that's what I think I can do. But your observation, I think, is really important. Okay, when people, I mean, I've sent this to quite a few people, and obviously the subscribers of Global Macro Investor are kind of the world's most famous hedge fund managers, asset managers. And I think it really shocked people and resonated with people. They're like, oh my God, everything makes sense now. And so once you see it, it all makes sense. Now, as it becomes more public as a thesis, and Mike Howell at Cross Border Capital has been talking some elements of this, liquidity, you can see liquidity becoming part of the conversation on financial Twitter and stuff now. What I think we'll probably do is create BoomBus cycles. Again, you can't have the bus cycle going below the level of central bank liquidity because optically they make it rise. This is what people don't yet understand. But of course, the stock market should go down 90%. Can't happen. Literally can't happen because of the debasement. It's a money illusion. But what I think we'll do is see, hey, off we go to the races. That's what happened in 2018. 19, early 20, we actually diverged from the central bank balance sheet massively because people started to figure out this game, which is the moment the Fed stop the tightening cycle, markets take off because they know that the probability of more cowbell, more central bank printing of money, more interest rate cuts is coming. And so therefore we get BoomBus cycles. So the boom times are too big and then you get a bust. And people know that from crypto as well. The long-term trend remains intact, but we keep getting these huge booms, collapse, boom, collapse, but the trend is still up. I think that's what we'll see. We'll be more like the crypto cycle, which is pretty much what we've just seen as well. We had a big collapse last year, and now we're straight back into the boom as we're starting to forecast. So we've got a fixed thing here, which is, can we put more output per calorie or kilojoule of energy? That is what productivity is all about. So technology keeps rising, and that's great, keeps going. But all of these governments are focused on the other part of this equation, which is, can I lower the cost of energy? Because if you drop the cost of energy from $40 per barrel of oil equivalent to 10, you 4x productivity. And there is your solution. And that is why they're pouring trillions of dollars into this. And we're seeing what's known as Wright's law, all these terms, which is the increase in output of a new technology has a commensurate measurable decrease in the cost. And we're seeing that with all of the green energy. So it's just getting cheaper and cheaper and cheaper and cheaper. Now, we can't scale it enough yet, but we know that there's nuclear, there's going to be part of this equation. There's a bunch of things, but over time, we will move away from that $40 fossil fuel anchor and move to $10. So think of the multiplier, because technology is doing this and the cost is doing that. That is what the productivity miracle that is coming.
So help me understand, why didn't the internet, which still to me feels like a productivity miracle, why didn't that change all of this? Why isn't it already the lily pad that you believe the exponential age is going to be?
So I think because it replaced jobs.
You don't think AI is going to replace jobs?
Yes, I do. But I think the productivity trend is a function of demographics as well. And I don't fully understand why the internet didn't do that, but it also hold out manufacturing jobs. So there was a balance on aggregate what happened within the economy. So I'm thinking it's on aggregate, it wasn't enough to offset these mega trends that we talked about that were driven by the demographics and the debt and the globalization. So I'm thinking it's that. And so we have to have an accelerant, because technology growth is not enough to offset demographic issues. And that's what I'm thinking it probably is. You know, we did create, trend rate of GDP has been falling. So whatever we've done with technology and the same number of people roughly, we don't seem to have pushed up GDP growth.
Let me ask a really ugly question. Hearing everything you're saying, it seems like, I know it's not, but I'm not yet sure why not. Why isn't the baby boom generation dying off and population contracting deflationary in a good way?
It is.
Well then, tell me more. I thought, so population collapse, my gut instinct is that it's terrible. What's the benefit?
The benefit is more stuff for you and I. Our per capita GDP goes up, and it's observable in Japan. It's observable in Switzerland. So GDP per capita goes up, and that helps offset some of these. Now, the problem is per capita is a nice economic term, but right now it accrues to mega giant companies. So it's a way of redistributing that capital amongst the people, which is important, which is why, I believe in things like Web3 technologies, because it allows more people to participate in ways that they couldn't participate in before. Because if not, Google captured it all and Apple capture it all. So I think there's a probability that as the population shrinks, it creates a slowdown in growth because of the magic formula. But if you can increase that productivity element, then we will be richer per capita. Now, there's a government problem of how you distribute that. You need to tax corporations more than they're being taxed. These giant corporations that pay no tax. Most people with an average business pays tax up to here. But Google pays, I don't know what their marginal rate tax is, 5%? That's wrong. And Amazon, because they're benefiting from the holding out of the American worker in the technology boom, and the people aren't, which is what's making people angry. Now, they're not doing it because they're bad people. It's just the set of cards they've been dealt with. It's been incredibly attractive to be, a super large company, particularly one with a growing industry like technology. So I think net, you can orchestrate it that per capita GDP rises, but you have to think about that issue of does it accrue to the people or not?
What happens if the population is declining, but productivity doesn't go up?
well, then we just go, trend rate of economic growth just keeps falling.
And so the reason I always assumed that the reason that population falling was a problem is there are fewer people that want to buy your goods, and that's why it hollows out the sort of GDP core economic engine. But as I think about it, it would also, it's interesting, it's going to create a weird sort of feedback collision, but it would increase wages. So if there are fewer people for companies to hire, that's great for the employees' wages. But if there are fewer companies because there's no one to sell anything to, now we have a problem.
Bad assumption. And this is, I can see the IMF got into this whole mess as well. And everyone now says inflation's going up as population dies out. Bad assumption, because technology is in the business of replacing costs, and they will just find ways to employ less people. I mean, again, you and I have talked about this, is like 10 years ago, video editors and sound people, etc., were really expensive. But now we can do it on AI. So people have to do 2 or 3 jobs, they hustle. It's changed the structure of stuff, and technology will just keep looking for the cost and replacing it. It's relentless. It's the biggest observable trend, is once you digitize things, the cost goes to zero in everything it touches. Inflation is a generalized rise in prices. The price of eggs goes up, the price of gas in your car goes up, the cost of employing people goes up, etc. Debasement of currency is this really weird little trick. Things of fixed supply or relatively fixed supply go up immensely, optically, because the price of the currency's fallen. Things of variable supply, like wages, corporate earnings, don't, and they don't go as much. So,
and so they literally just make it up. So if we were back in the days of printing, you would just turn the printer on. That's why they call it printing money, though now it's just a database entry. But if we were back in the printer days, you would print more. Would we run into a problem if we couldn't create more money because more people are being born, the population is going up? If money, like I think about this sometimes with Bitcoin.
That's what a depression is. A depression is when there's not enough money for the demands.
Like literal money.
So what happens is the opposite of the debasement. Assets get devalued, and currency, which is the thing that's in scarce supply, but the money is the thing that everybody desperately needs. When that is extreme, that's a depression. What we're seeing now is the opposite. So we've got inflation, but they've reduced liquidity to try and cool the demand. And people want preferring to try and get hold of money as opposed to assets, and the price of assets has gone down. So they've actually done the opposite. Quantitative tightening is the opposite of quantitative easing. So theoretically, if quantitative easing causes assets to go up, then quantitative tightening should make asset prices go down because you're making currency scarcer. Simple.
Okay, so I've asked this question before, but I forget the answer. How do they quantitatively tighten? How do they get money out of supply? Because they're not going around burning paper dollars. So how are they doing it?
They're just buying it. So they're buying bonds from banks or other participants.
Wouldn't that put money into the system? Because at that point, they're buying something. So sure, they're selling off their bond inventory. So they're doing the opposite, right? So they give people something, but they take the money and then they hold it.
Correct.
And so that I wrote that down as you were talking about a depression. A depression really isn't that the money goes away. A depression is that the money is now locked in people's wallets, bank accounts, whatever. They still have it. They're just not moving it. Is that correct?
And you can't get it for love or money. You want the money. And so the depression is well, all the assets fall in price. It's all supply and demand in certain ways.
Yeah, it's all psychology. I mean, this is the utterly fascinating thing that I'm sure we'll keep looping back to. Okay, so money isn't moving during a depression. And so I was talking to Robert Breedlove about this, and I still have a nagging feeling, as much as I don't, right now with my limited understanding, I don't like that money's being inflated. Right now with my limited understanding, I absolutely love Bitcoin because I see how it's going to hold my wealth over time. But there is a part of me that keeps asking the question, am I actually mad at them using this cycle? Because if this game really is psychology, And we get all of the innovation and everything that we get because of innovation. And to get people to innovate, and I'm remembering now how Robert swatted this down, but I'll be curious to hear your thoughts. So my default position is that people innovate because money is moving. So you make something and people don't think that their money will be worth more over time if they hold it. So it is not a good asset in that sense. They think it'll be flat. That's how I think most people think of it. I think inflation is sort of invisible. Most people don't account for it until you get into a higher inflationary environment. And so they think of their money as being flat. In truth, their money is actually declining in buying power because of inflation, but they think of it as flat, or at least I always have. So I think of my money as flat. People think of their money as flat. So if I want a Kit Kat bar today, I'm just going to give you money for it and I'm going to eat the Kit Kat. But if I think this is like the joke that people make about the guy that bought a pizza for 20 Bitcoin or whatever, it's like, bro, that's $67 million, or whatever at the height. And so what a fool you were. That is when your money is depreciating instead of inflating, or deflating, instead of inflating. So you've got this trick that happens psychologically when the banks put money into the system. You feel like your money is going to be worth the same tomorrow that it is today, and so you don't have a problem spending it. Does that seem crazy to you?
No. So it's all about this marginal propensity to consume or to save or whatever, and that's your expected future value of money. The reason there's not a lot of velocity of money in Bitcoin, there's a lot of hodlers, is that the general view is, well, I'm going to be better off if I just hold it. Right, which is why nobody's going to use Bitcoin as a transaction layer, apart from Lightning, because it's just the blockchain rails. But why would you? Because nobody wants to be the Bitcoin pizza guy. So you don't. So it's actually kind of deflationary in that respect. And all of this is a game. It's a game of who are the other competitors in this game? Who are the rules, as you would call them, right? Okay, we've got the central banks. They want to do one thing to us. We've got the asset prices, and they can do another thing based on whatever's going on there, if you're investing in commodities or equities or whatever. And I need to navigate that to get to where I want to get to. And I have this base assumption that my cash is going to be flat. So I put 10 grand in a bank. I'm assuming my 10 grand is worth 10 grand. We know it's not, but in a 1 year time horizon, we don't really care if it's worth 2% less because we don't notice that. So then we're looking at the other levers and saying, okay, what is going to deliver what Tom wants, which is I want my money to offset debasement, not inflation, because crypto's done a terrible job of that, as has everything, including gold. I mean, virtually nothing offset this inflation we've just had. So that kind of took us all by surprise. But the debasement, well, I just divide all of these assets by the Fed balance sheet. That's really interesting. The S&P kind of goes nowhere. It's right at the bottom now since 2008. So as they started using the Fed balance sheet, debasing the currency, the stock market has just accounted for that. The Fed balance sheet's been doing that. The stock market's done that. But actually, they've netted each other out. You haven't got any richer. Gold fails. You've actually got poorer versus the Fed balance sheet. So the big gold narrative failed. I don't know, probably because of crypto. So people just had a less marginal propensity to use it. In a digital age, gold is not actually that useful. The NASDAQ did actually pretty well. We're still not back up to 2008 levels, 2007 levels, but it's been going up. Why? Technology. Technology is a secular trend. The S&P 500 does not have a secular trend behind it. So, and then when you put crypto is the only thing that's really outperformed, because what you've got there is you've got technology and this kind of whole network adoption model, and it works really well for debasement of assets because it's scarce. Technology companies aren't scarce, really. You can just keep building them, but you can't do it here. So it works phenomenally well. So you're taking the bet that future Tom wants to not have screwed up, and therefore future Tom wants to choose the asset that he thinks best represents the set of risks that he sees that being played at the table in the game. And that risk to you is debasement of currency, which I think is probably the larger risk. And therefore, Bitcoin or crypto is the best bet to take. But it depends what future you is, depending who's watching this and what they need. Because some people want to protect, some people want to grow, some people want to, there's different motivations. But generally it's protect what you've got so you can maintain your level of who you are, because nobody wants to ratchet down the reality or their expectations of themselves.
There's psychology again. So velocity of money, this is a very interesting concept, and I hope everybody takes me as you would take somebody who is learning something. Every time I get a new piece of this puzzle, it does feel like the emotional ups and downs are easier to deal with. I won't say that I feel that I'm better at predicting, and I do want to talk at some point before we go about looking forward to 18 months and what that looks like. But first I want to contend with this idea of velocity of money. So the rate at which money moves seems to be the thing that the Fed is trying to influence because they understand the psychology. So roaring 20s, if I had to guess, high velocity of money. 1930s, I know because you said earlier that a depression is when the money stops moving. So depression, low velocity of money. I think it was Jerome Powell that said recently, I want to keep cranking up rates because it will slow the economy, yes. And if I go too far and I break a bone, that's okay because I have tools that I know how to use to fix a broken bone, but I don't have tools.
Basing your currency.
Exactly. So, but this goes back to the velocity of money. And so, okay, I'm putting this all in context of a guy who has a meaningful, not a scary, but a meaningful part of my net worth in Bitcoin, because I believe in the narrative of it will hold value over space and time. There's an interesting note there to be made about, did Bitcoin just inflate gold, which is an utterly fascinating thought. And that 50 years from now, will there still be gold and Bitcoin? Anyway, so I believe in Bitcoin. I believe in its ability to hold that. But I also have this feeling, especially now sitting in the soup of all this madness has happened in crypto with fraud. Yes, it happens everywhere. Cool. But my punchline is that regulation, I'm always tempted by the libertarian notion of just like, don't tread on me, let me do my thing. But then I'm like, humans, like, they'll find the edges. There are psychopaths among us. Even if SBF didn't mean to be a just absolutely ruinous psychopath, like that's what ended up happening. And I can only imagine the human agony expense of $9 whatever billion that ends up getting lost. Like, whoa, that just absolutely devastating. Okay, so sitting in that soup, I find myself going, I'm actually okay with a certain amount of government. I pay a lot of taxes. I do have a breaking point where I start to get really annoyed and feel like it's being overstepped and misused. Let me try to put all the context on the table here. But I don't feel like just, no regulation is the right answer. We need some regulation to all of this to keep people from going crazy. But God, is it my ignorance that's telling me that the central banks may not be the worst thing ever? Oh, I know how people that know more than me are going to have a seizure. But I can't help but think, given that this is a game of psychology, given how easy it is to sort of nudge humans in a direction, that they could clamp down on their money, be too paranoid to spend it, and that it isn't necessarily a bad thing that we do have this tool to nudge it. Now, conspiracies, the beast from Jekyll Island, like, I understand all of it. And so it's like, it's all sort of bad, but on balance, I come down on, I don't know, the system seems reasonably functional. How crazy does that sound from your far more knowledgeable perspective?
So there's a few things. First, velocity of money is, as you say, but it's a demographic phenomenon. So velocity of money has been super low since 2000.
So not influenced by the Fed?
No.
Interesting. Whoa, okay, shocking. You're smacking my worldview around.
They have not been able to.
Interesting.
Because psychology. Who is hoarding money? Baby boomers. The same people who cause the inflation are causing the deflation or disinflationary trend because they're hoarding money because they're now 75 years old. And all you want to do is make sure you don't die destitute at 85 or 90, right? Imagine if you're homeless at 85, right? So you are driven by one of the strongest psychological factors you have is, I cannot get any worse than I am today, right? So you're a hard stop, so you won't spend. So the baby boomers have stopped velocity of money. And I've proven this with charts over time, that that's what's causing it. That's why we've got this disinflationary trend in the world, even though we're in a temporary inflationary trend. And it's been that the Fed have debased currency to try and offset. The baby boomers have, and I did this whole long 2.5-hour thing that people should watch on the Real Vision YouTube channel with Robert Breedlove about why we got here. It's a very long 2.5-hour video, and I can't tell you how important it is. But the baby boomers, with the debasement of currency over time, found that their income didn't go up, but the assets did, because there was too many of them competing for these assets. This is before debasement. And so they borrowed money to fund the gap when we started the big debt boom. It was all driven by this demographic. So yeah, go and check out that video. I think it's pinned to our YouTube channel. That's a big issue here. It's a bigger issue with this demographic game, because that's one of the rules of the game that you can't change.
So what happens over the next 15 years as boomers start dying?
They will get, firstly, more propensity to not spend. So when my dad retired, Dad used to quite like spending money. You know, he was reasonably, you know, he was a middle class, did reasonably well, not phenomenally well. And what happened the moment he retired, he's like, fuck, this is a fixed sum of money. I don't know how long I'm going to live for, and my wife's probably going to outlive me. So his spending pattern probably in 2 years fell 65%.
Wow.
You know, he was the guy who'd buy champagne. He'd go out for dinner with friends, buy a bottle of champagne, whatever, blah, blah, blah. You know, by the time he hit 76, he'd be on the €5 special at the supermarket because he just didn't want to not run out of money. The worst thing for him is him to die, which he did, and leave my mum with no money, because then his whole sense of self is tied up in it. So anyway, so it's really strongly driven by these kind of things. So I think as they get older, it actually gets worse.
But they are going to die. So we've got, I'm going to guess, 15-ish years, and then they start dropping like flies.
That's right. And so then we've got the other issue, right, which is depopulation of the world, right? That's coming at scale. But this gets offset by technology. So if you look at Amazon warehouses, Amazon is employing robots at a faster rate than humans. And the robots, there's now 500,000 of them, and 1.5 million people work for Amazon. But the robots work 3 times as many hours and are probably twice as productive. So, and they never have a holiday, nothing, right? So that's going to happen at scale and replace the baby boomers.
But what's going to happen when the baby boomers' money floods into the system? I mean, I heard some crazy number about how much money baby boomers have locked, but they're going to give that, I mean, charity, kids, whatever, but it's going to come in a pretty rapid
I've heard
clip.
this story before. There's one economy that's led everything. That's Japan. The issue is that people start living longer. The Japanese actually passed on the wealth to their retired kids.
Whoa.
That was the problem. Because if you lived to 90 and you had your kids at 20, your kids are 70 by the time you die.
Wow.
And so they didn't get the wealth effect of the changeover in wealth. Now, not every economy is as long living as Japanese, and the Americans are 42nd longest living. It's inexcusable. Considering GDP, how much they spend on healthcare as a percentage of GDP, it's inexcusable what happens in the US. But
you just can't eat like that. I'll just say it.
Yeah. You can't eat like that, and you can't have the drug companies involved as far as they are. So I don't know if there's a big wall of money coming, Tom.
That's almost more scary.
And I think people's jobs get replaced by technology. But I think there is a productivity boom, which we've not had for a long time because of this retired population and debt. I think this, what I call the exponential age, this rise of technologies, may give us more wealth per GDP. So it'll manifest itself in ways that we don't know. Now, it doesn't matter if it's stuck, right? Because as long as it's in a pension fund that's investing in VC, that's driving technology, it's okay. I mean, the worst thing to happen is for you spend it on of everything. But given the basket of stuff, I asked many people who were like, I hate the Fed. I'm like, okay, 2008, what would you have done? Well, I wouldn't have got there in the first place. I'm like, okay, but they did. And how do you get there in the first place? Well, and again, watch that video with Raoul Breedlove. I'm like, well, that was a factor of globalization. Would you have stopped that and foreseen the outcome of that? And then that was a function of the baby boomers and World War II. And there's so many factors. It's like, no, they're doing the best that they can. Now, nobody wants the debasement of currency, but if you don't, what is the outcome? That's why I ask people. If you don't buy the debt, if you allow the collateral of the system, because the US is the most indebted economy in the history of the world as a percentage of world GDP.
Whoa!
It's over 100% of world's GDP in debt.
That's a lot.
And that's not just, that's the country, the people, the corporations, right? It's the whole lot, the total debt. So what do you want to do? What do you want to do? Do you want to let all of that collateral go to zero, the whole system burn to the ground, and a complete destruction of lifestyle, even whether we're living in a fancy lifestyle driven by debt and other stuff? Do you want to destroy all of that? I don't think you would. I don't think anybody would. So in which case you need the central banker to try and just juggle the bloody balls in the air. And yes, we get angry because it kind of gets the rich get richer because it keeps driving those assets up, and the poor get poorer. So we have to focus somehow on that. But America doesn't like the idea of helping poor people. They think it seems to be, you're a communist. It's ridiculous. You know, why would you not have a welfare state if you've destroyed the ability for wages in real terms to rise over the last 50 years? They've not risen at all. So you need to think about this, and this is why technology people are thinking about universal basic income, because these same people in the workforce are going to compete against robots and have no chance, zero chance. So there is a lot of structural issues here, and I don't think you can do this without government. And I don't think you can do it without central banks. And I don't think central banks, they've made some mistakes, some big mistakes. They made a mistake in 1997, which was cutting interest rates to defend the stock market. The leverage hadn't built as big by then, and we could have had a clearing event, and the leverage wouldn't build up. That's what's happening in crypto, right? The leverage can't build up. It just cannot do it because it keeps getting blown out. Why? Because there's no counterpart. But look at how vicious the cycles are. So do you want the whole economy to go through the crypto cycle? Well, you can do that. That's not having a central bank. There's so many trade-offs as you suggest. So I think for a generalized population, you would trade smoothness and some level, acceptable level of debasement or inflation, whatever you're looking at, some acceptable level, versus an economy that does this, and you don't know when to save or how to invest because the wealth.
Yeah, I don't even think we would ever get there. I think people would turtle up so fast. You would just be in protect mode. Man, even just looking at, so I, as somebody who...
But this is going to make us really hated, this video, Tom, because we're both saying the same thing. And people are going to go, how dare you? Can't you see what they're doing?
I get it. And that's the thing. I wanted people to know, like, hey, the beast from Jekyll Island, the conspiracies, like they may even all be true. Let's just assume for now that they are true. All of it is still born out of the nature of the human animal. And they're having now been in, I'll say blockchain instead of crypto, because the part that I function in is very much not a currency. Looking at that and going, hey, I'm totally down for some rules. I would just like to know what those rules are. I don't want to have to guess at what the rules are, and then you come later and you're very angry. So I like to just, let's have what the rules are. We can debate the rules, we can fight about the rules, all that. But now we can move forward in a far more reasonable way. But I don't think that things settle on stability if you have the ability for the more powerful, that could be physical, could be intellectual. Like, I really think Sam Bankman-Fried has a talent for being able, and it could be just of this moment where that sort of, he's got the geek chic look. I actually haven't even seen an interview with him, but I will assume that what I hear is correct, that he's a very smart guy. He's certainly able to convince people that he's a smart guy. So he understands something about this that he was able to leverage against other people. And I think that will always happen. And what governments are is basically, and this is going to sound terrible, but governments are the weaker people saying, well, we're going to get our asses handed to us physically, intellectually. So let's come together as a collective. And as much as like that can spiral into tyranny, I'm well aware, as somebody who runs a business in California, let me tell you how aware I am of that. There is a pathological side on that side, but I think there's a pathological side on this side. And if we're going to find a real path forward, I think people need to understand the rules of the game. I think we have to stabilize the rules of the game.
I'm going to add some complications to this too.
Please, of course.
So one of the arguments about the Fed that people have is they're not elected officials, and therefore we should have a say how much our currency gets debased or whatever. But the crowd is not always very good at making these decisions either. And Brexit is a great example. Brexit, the unintended consequences have been enormous.
I don't know anything about it. So what have been the second and third order consequences?
So there was, all these Brits love to go on holiday to Spain, France, Italy. They had all their holiday homes. They got to retire. They wanted to spend 6 months a year in one country. And now they're finding they're not allowed to. And they have to leave. And they're like, what? But we're British. How dare you? And we're like, no, you're not part of the EU anymore. You have no rights. You have no rights over the healthcare system there. And they're like, well, this is not what we agreed to. At the border in France, you can drive a car from France to Spain to Italy to Austria, do anything you want. You don't even go to passport control. Brits at the border in huge long lines getting in and have to produce all the right papers. They're like, but we're British, how dare you? Like, you voted out. So normally speaking, that should have been done not as a referendum. It should have been done as a political process, and that was going on as a process that takes years of debate and discussion, and voters can say we like that party because they're against leaving or for leaving, and that's fine, but it gets debated properly over an extended period of time. What we did was say, you make a decision instantly. And everyone's like, what? Okay. Completely not given the tools, and they screw up. So do we want to give the same tools to everybody with interest rates? Do they even know what drives the economy? Now, no, I don't think the Fed are particularly good with that either. I think they do a terrible job on forecasting the economy. And that's why, FinTwit gets so angry with them. It's like, it's bloody obvious we're going into recession and you won the battle on inflation, but you're going to keep fighting it and you're going to make it worse for people. And then people are going to lose their jobs and going to be angry at you again, and so on and so forth. But nobody's ever managed to make the business cycle flat. Nobody. It's a degree of what volatility you'll accept.
When I started doing the research for this interview, obviously you and I interact quite a bit, but when I started doing the research for this interview, I thought I would hear a lot more pessimism out of you about recession, about, global economic collisions from Russia and Ukraine to China, and that looked like they were imploding for a while, but you're pretty optimistic. So I'm very curious, what's happening right now?
So firstly, most people need to realize that doom porn sells. It catches attention. Fear is the strongest human emotion, right? And so you see a lot of it because it grabs attention. So we need to break apart to two parts here. One is, what do I think of the economy? And the other is, what do I think about markets? So my economic view is, I think most of us even know it, is we're in recession. We're in recession and it's probably going to get a bit worse. And there's a lot of people going to lose their jobs and businesses are going to find it hard. There's less money around and it's going to be pretty miserable. And it's the sort of miserableness that you go through periodically that is not catastrophic. So it's a recession. And recessions are as old as humanity itself. So we've just had, what's confusing people in my view is we're so screwed up by the last three events. One was the pandemic. So there's no normality. What was the recession look like there? That was the weirdest one. Then 2008 was the end of the entire financial system. And then 2001 was this spectacular tech collapse. So people have an anchoring bias. It's like, well, it's the end of the world. Really, when I graduated university, it was 1990. And it was a terrible time to graduate because it was a recession and there were no jobs. And I wanted to go into finance and they were firing people as fast as possible. And it took a while. It took a while. House prices went down for a while, and people didn't get jobs for a while, and people were laid off for a while. And the stock market went down 20%. It was a decent sized recession as well. Went down 20%. Took some time to recover. The jobs came back. The economy was cleaner. They got rid of some of the worst excesses of leverage, and the world moved forwards. And before you knew it, all of the 90s was a boom. I'm kind of that opinion, is we have no systemic collapse coming. We don't have those kind of issues, and we've invented the magic printer, the money printer of quantitative easing that papers over all troubles. So we don't have that coming. Societally, yeah, we've got a whole bunch of issues to get through a US election with all this AI and the anger and the populism, but forget all of that. Again, you can easily go down the doom, or you can enjoy the community you've got around you. And there's different ways you can have lenses, perspectives on the world. Investing, the job of markets is to look forwards. If you tell me 100% of all economists are forecasting a recession, it's kind of no shit, Sherlock. And therefore, is it in the price, or are all those stock market people really stupid? All of those machines that they haven't heard you at all? No. They actually understand this, and it's a real-time probability weighting business, so it kind of knows that. And what it looks forward to is, okay, how bad is this? Is it catastrophic? Is the world going to end? What's going to happen? And the markets are telling you, no, it's probably done. My view is the bottom is in markets, and the bottom was in crypto in June, and for Bitcoin was in October, November. The bottom was in for the stock markets in October, as most end of bear markets happen. It priced in a recession, and we move forwards from here. And eventually they'll cut rates again. And if you think about it, is we had a total shutdown of the global economy, then a reopening of the global economy. That's caused this inflation that's hurt everybody. And eventually we'll just rebalance back to some form of normality. There's a massive amount of doom porn about inflation is going to be structurally here forever, we're all going to die, which is kind of, I'm more like you are with the AI side, where I'm actually like, you know what, we've just developed AI, we've got relentless technology, the price of energy is coming lower from all different sources, productivity of humanity is growing. So I think it's actually probably an interesting time. It's an interesting time because everybody's so bearish. Psychology plays a huge part in markets, because everybody expects inflation to be relentless and ongoing and for the rest of our lives, much like, 24 months ago, everyone was like, every tech stock's going up forever and every business can never fail again. You know, we're humans, we make forecasting errors of quite wide amounts at various points. So yes, no, I'm not just saying this because I'm just chatting to you. I mean, I do an enormous amount of work on this. I write 150 pages of research. I sit down and write it every month. I've been doing that for 19 years. And so that comes with 2,000 charts and models and stuff with myself and my colleague Julian Bittle, from secular themes, short-term themes. Doesn't mean I'm not wrong as well. I can clearly be wrong, but I just think it's in the price. And the worst part of it is the stock market's going to be going up probably. It won't rocket up at first, but eventually it'll pick up while we're all feeling the pain.
Because people are looking forward, and so they're saying, okay, the bottom's in, now's the time to get in. We know we're going to go up from here. So even though we're still sort of going through it, people are losing their jobs, but wise investors are like, you just need to project this out into the future.
Yeah, so there's a time horizon of how the business cycle works. Currently, the thing that leads it the most is the Chinese credit cycle. Who knew? But it is right now 17 months ahead. So when it turned up 17 months ago, we're starting to say, okay, there's something happening here. It also forecasts the recession. And then you've got other forward-looking indicators about 9 months out. We've got a bunch of indicators. But the last thing in the stack is rents. And the one before that is wages. So wages are going up right this now, but they take a while and then they start coming down again. They won't deflate. Nobody's going to really come to you and force you to take a pay cut, but it means that they don't keep going up. But your rents will probably come down. And so that's a function of these things just take time. The unemployment rise hasn't even started. Now, we can see everybody laying off. Every company is laying off people, thinking about tightening costs. Everyone can see it from sponsorship, advertising, sales. I mean, it's everywhere. I mean, every single person I speak to is like, Christ, it's miserable out there. But the unemployment side doesn't really come until it should start in the next month or two. And then that goes on for 9 months of just relentlessly higher unemployment rates. So anybody watching this...
Why is that so predictable? Why 9 months?
It's just how it always is, because companies make decisions, and whether it's around board meetings, however it's done, they get to a certain point where they hit the panic button and they lay people off. That's usually when the bottom of the recession starts. It's usually when rates start getting cut. It's usually when the stock market often recovers as well. So for people watching this, there's two parts of this. One is, if you're an investor, you might be able to buy these technology stocks with this renaissance of amazing changes happening around us at prices down 70% from where they were 2 years ago, a year ago. Okay, that's kind of interesting because your expected future return goes up. Same with crypto. You and I've talked about this. You buy when the business cycle brings it back to the bottom of the secular uptrend. That's where we are. These are where you make all the money. This is what you get paid for, to take risk here. You don't get paid to take risk at the top, and you tend to lose money. So these are the moments in time. So that's very interesting as an investor. But anybody watching this, think about your cash flows. Just think about your cash flow, think about your expenditure, and just be a little bit careful, because losing a job or having your own business struggling for a period of time, and I think the worst of it will be over relatively fast, but yeah, it's these laggy effects.
Me, what's relatively fast?
So I think
if we're recording this in March of 23, when do we think this turns around?
So I think the bottom of the economic cycle is in the next quarter. So I think we've got a really ugly quarter to come. But the problem is, it's that shock that sets off the companies to go, I need to lay off some staff, all of that. And it's that process that begins the healing. So
what is that shock? So if that shock isn't people getting laid off, what is the shock that's coming in the next quarter?
The shock coming in the next quarter is the general slowdown from interest rates, biting into all of these indebted companies or households or credit cards and all of this stuff. And everybody goes, I'm not going to spend money. That is what a recession is. It's not usually driven by a pandemic. It's not usually driven by the entire financial system collapsing. It's usually by all of us making a rational decision of, I'm just not going to spend money right now because things are a bit uncertain. And that is what causes recessions. And I'm actually telling people to do exactly that because it's the rational thing to do. What you do, if you're going to panic early. And I'm not talking about the stock market going down either. I think we've had that. It went down, the NASDAQ went down 38%. That's pretty much bang in line with a regular bear market. But what I'm saying is, in your personal life, where it really matters, where the rubber hits the road, is panic early. Just look at your expenditure, look at your cost, look at your business. So what do I need to do here just to make sure that I can just get through a pretty shitty year? But 2024, probably pretty decent.
So what is the natural cycle of things? Why do people begin to warm back up? And what are the threats, if any, that you see looming? So housing, I'm hearing housing bubble bursting, problem
Doom
there.
porn. Doom porn.
Is that it? It's just people are overreacting, not real.
The housing market is expensive. Interest rates have gone up, so people are going to buy less houses. Yes. Will house prices come down? Yes, because they went up a lot. Will the activity in the housing market dry up for maybe 2 years? Yeah, most likely. Are we going to see a leverage crash? No, because nobody's really got a lot of leverage at household level in property. That was something that happened in 2008. It's been too expensive and too difficult to do. So I think the home builders have a bit of trouble because they got a lot of inventory. They can't sell it. They need to finance it for a couple of years. It sits around 1990, 91, 92 was very similar. I was in London then. It was pretty shitty in the property market. It was great for me because I just entered the property market at the end of that. So prices were relatively low. They hadn't come down a lot, but they hadn't gone up a lot. And my income was going up because I was in my 20s. So your income goes up every year because you're hopefully getting promoted and stuff like that. So, but, a few property developers went bust. Things were slow. And then eventually it cleaned up. So I'm more of that opinion that, house prices come off 10%. Maybe even 15%, some areas that were really hot come down a bit further, but it doesn't expose any catastrophic leverage. The banking system is more than adequately compensated with capital. It's hugely sold in the United States. So it's just a bad time. It's just a bad time.
What do you think about rates? Are they going to continue to go up? Because the Fed, as far as I know, is signaling that they are going to keep taking rates up.
Yeah, so every single forward-looking indicator that I have on inflation suggests that inflation utterly collapses. If you want to see a real-time inflation data, look at something called Truflation, TRU-flation. It's actually on blockchain. It takes hundreds of thousands of individual prices on a real-time basis. And it tells you where inflation is today. And US inflation today is about 4.74%.
Wow.
Versus the headline, which says 6%. So, and if we think of what inflation is the year-on-year comparison. What happened last year? Well, between March and June was Russia invading Ukraine and every commodity going through the roof. So we're going to see the flip side of that. So we will see inflation come off very fast. All my forward-looking indicators that look at it from different angles all suggest the same. So I think the Fed is speaking max aggression because they want to make sure that out of the embers doesn't rise the phoenix again. So they just want to stamp out people's expectations of higher prices in the future. They know there's a recession coming. They can see the inflation's coming. So a recession's coming. So I think it's the final game, which is like get down and stay down. And then that's what they've done. And so my guess is we'll be having this conversation in September, somewhere between September and December, and they'll have cut rates.